I will be covering the 2022 Draft Tax Laws Amendment Bill, some of the major developments that have happened that have come out in that bill. Before we get started, I'd like to introduce my fellow speakers today. I'm joined by the rest of my team. Anushka Thilakdari will be presenting straight after my session. Anushka is a senior tax advisor on my team. She will be talking about the 2022 Draft Tax Administration Laws Amendment Bill, as well as the two-part retirement system, which is quite a controversial new system that Treasury has introduced for retirement funds. Bruce Bosch is also a tax advisor or senior tax advisor on my team. Bruce will be discussing certain interesting tax cases that have been decided over the last year or so. And then finally, we'll round off with the youngest on our team, Mfundo, and not only the youngest, the most attractive, Mfundo. Mfundo will be covering recent developments at SARS. Before we get into the details, a few housekeeping rules I just want to run through, which will hopefully enhance your experience. Firstly, as participants, you are automatically muted and chat functionality has been disabled. If you have any questions during the seminar or webinar, please use the Q&A tab at the bottom of your screen. Your questions will be submitted to the panelists and we will answer them as soon as we have the opportunity to do so. We will select a few questions to discuss in appropriate time, but unfortunately, we won't be providing any written responses to questions. Of course, if you want written advice, we're happy to charge you for that. Then the webinar is being recorded and a copy will be available on our website later this week at www.bowmanslaw.com. With regard to CPD attendance certificates, these will be prepared and sent through to you. If you don't receive them by the 15th of October, please contact me and I will arrange that for you. So before we get into the nuts and bolts, let's have some comic relief. There's a few things that I just wanted to comment on before I get into the detail of today's session. I joined a few sessions of the Tax Indaba that was hosted by the South African Institute of Tax Practitioners, or should I say South African Institute of Taxation last week. Some of the panelists had interesting things to say, and in some cases, quite scary things to say. In particular, a swearing, profane political economist commented that unless something drastic happens, South Africa was going to be a failed state within 10 years, which to me is quite a scary thought, and hopefully it doesn't come to pass. Professor Keith Engel is the CEO of SITE, and he was previously a director of tax policy at National Treasury, and he said a few things that struck a chord with me. The one thing he said was that the tax system alone cannot cure South Africa's ills. You can't have the tax system on its own as a means to remedy the faults that we find. And South Africa does not really have a tax problem. It has more of an expenditure problem. And if you look at the scenario that we've seen unfold over the last few years, despite our economic situation, SARS consistently collects more revenue than its revenue targets. There was 1 or 2 years where, revenue targets, we didn't exceed revenue targets, but generally we do exceed revenue targets. South Africa's tax to GDP ratio is comparable to many OECD countries and is close to 30% of GDP. And if you think about that, that means for every rand of production that happens in our economy, 30 cents of that goes to SARS, which is quite a high percentage. Now, a SARS economist who was a panelist at the Indaba mentioned that the tax gap is estimated to be between 200 billion and 300 billion rands. And to me, that means one or a combination of two things. Our measurement of GDP is incorrect, which could be true. Maybe we're not measuring the illicit economy very well, and GDP is understated. Or SARS is simply collecting too much tax from too few taxpayers. And the tax base needs to be drastically increased or broadened by identifying tax dodgers. Our problem, I think, is from a tax point of view, is that we've got too small a pool of taxpayers who do not necessarily get value from their tax spend. Much of the tax revenues is wasted through misuse, corruption, wastage, and unproductive behavior by government employees. And it's a little wonder that the taxpayers are aggrieved. It was a bit disconcerting to read news reports in the last 2 weeks, which said that the OECD had conducted a study and felt that to remedy some of the country's ills, taxes should be increased. Some of the ideas touted were an increase in personal taxes, And to me, quite frankly, we pay amongst the highest tax rates in the world compared to the value of public services that taxpayers do receive in return. They talked about the introduction of a wealth tax, and there were some numbers bandied about that, wealth tax would yield about 160 billion rands in revenue. And they also thought, touted an idea that there must be an increase in the VAT rate of between 2 and 3%, which is never a popular thing to implement. My personal view is that our tax base is too small and is already too tightly squeezed, and any further increases in taxes is not really going to help. At a micro level, what we're seeing or what we're observing in practice, particularly over the last year, I'm finding that taxpayers are getting tired of blindly just contributing to the government coffers, especially as it seems that the government is not really appreciating the dire state in which the country finds itself. And my general experience is that taxpayers are consistently looking for ways to reduce their tax liability. Now, of course, with my clients, that generally would be in a legitimate way rather than in an evasive way. Many taxpayers are looking to diversify their investments and increasingly invest offshore rather than onshore. And I think that riots last year really has spurred that particular movement. Then looking at those individuals that have gone overseas to work and, have not necessarily made up their minds whether they're going to return to South Africa at some point, increasingly, because of tax rule changes and enforcement by SARS, many of them have decided to completely exit the South African tax system. And we're seeing a lot more applications for cessation of tax residency, which Mfundo will cover or touch on a bit later. From a SARS perspective, what we're seeing is that SARS is making strides in identifying and bringing to book certain tax dodgers. One needs to look no further than the gold leaf tobacco case to see what SARS is doing. And the thing is that those kinds of cases take long to investigate. You're dealing with taxpayers that have deep pockets and can take evasive measures. And it takes rather long to complete an audit and then to actually collect the tax that is due. Now, the sad reality is that SARS is looking for money, and it's far easier for SARS to audit taxpayers, particularly those taxpayers that are already on its register. So we're expecting an uptick in the number of audits that are going to be conducted, particularly multidisciplinary audits and targeted audits on problem areas. And Mfundo will cover later, about the IT14 SD requirement being removed. I think that's going to result in a far more SARS audit queries on specific issues that taxpayers may not necessarily have seen over the last few years. Increasingly, what we're seeing as well is SARS is taking a hardline approach on the imposition of penalties, and is using this as a revenue generating mechanism. The room for error is very small now. And the reality is that even if it's a bona fide error, SARS' position is that the taxpayer has either not taken reasonable care or has taken an unreasonable tax position, and their starting point for penalties is in the 25 to 50% range. So our advice to our clients, John, no matter what they think about the levels of the taxes that they're paying and that it's unfairly high, our advice is don't take unnecessary risks and make sure your compliance is in order. So with that, I would like to move on to the actual amendments for the year. So before we get to the 2022 amendments, I just want to highlight some of the 2021 amendments that have now come into effect. And the two big things that came into effect was firstly, the corporate tax rate being reduced to 27%. And this is effective for years of assessment ending on or after March 2023. For some taxpayers, then this already is in effect. So you've got those taxpayers that have March year ends, for example, your Mr. Prices and your Tonga Tulips and so on. Those will already be subject to the 27% tax rate. For those taxpayers with the December year end, this will be applicable for the first time in the 2023 tax year, and those with the February year end will be applicable for the 2024 tax year. So together with this, obviously, from a financial reporting point of view, one will have to remeasure deferred tax liabilities and so on. So something to look out for. Now, remember, the reason why the corporate tax rate was reduced to 27% was to, stimulate investment it is questionable whether 1% drop in the tax rate would necessarily cause that additional investment. But the manner in which this rate reduction was introduced was meant to be in a revenue neutral manner. And there's two balancing proposals that came through, which was put into our legislation last year, but effectively gets switched on at the same time the 27% rate comes into effect. The first of those is the limitation of the utilization of assessed losses. And essentially what SARS wanted to do, or what National Treasury wanted to do, is broaden the tax base by restricting the usage of the assessed losses carried forward from a previous tax year. So that comes into effect simultaneously with the reduction of the rate to 27%. And for those taxpayers that have assessed losses, I think from next year, the issue is going to be making sure that your provisional tax payments, you take more care in calculating your provisional tax payments, whereas previously you wouldn't really have bothered if you knew a company was in an assessed loss position. The other amendment that came through was the limitation of excessive interest deductions for certain loans from non-taxable persons. And normally we see this in a cross-border context, but it could apply to onshore lending activities where the lender is a connected person or a controlling person, but is non-taxable, for example, your pension funds and so on. So something to be aware of. Obviously, we covered this quite a bit in detail in previous seminars. So I'm not going to rehash that now, but I just wanted to highlight to you that this has now come into effect and something that you need to plan for. Then it's good to look at where we are in the legislative process. Remember, in February of each year, the Minister of Finance reads the budget speech and he includes tax proposals in that budget speech. In July, in this year it was the last week of July, National Treasury released the tax bills for public comment. The commentary process, I think, has come to an end or is about to come to an end right now. And this year, we didn't see too many amendments. So compared to the previous years, where we saw rather major amendments coming through, this year it was quite muted. But there's still, a lot of devil in the detail. You'll see there's quite a few amendments, but impacting different industries and different types of taxpayers in different ways. So once the commentary process has closed, Treasury goes through through a consultation process, which happened over a few days last week and some days this week. And they will now consider those comments, and the final draft bills will be released around about October, with the medium-term budget speech is read. Now, once those are released, it's unlikely to change, and then the bills are normally promulgated in December or January. But obviously, as you'll see as we go along, there's going to be different effective dates for various amendments. So it's not necessarily when the bills come into effect that all the amendments come into effect at the same time. So where we are at the moment is that whatever we're going to be discussing today in terms of the draft bills is exactly that, it's draft. So it's subject to change. It could change in the next version of the bill. So something to just be aware of. Today's session is meant to be almost like an awareness session, education session, some things taxpayers need to plan for, but just be aware that there could be some changes before the final bills are actually promulgated. So moving on to the draft tax laws amendment bill. So under the category of individual savings and employment, there have been a few amendments that have been proposed. The first one relates to variable remuneration. Now remember, we've already got a specific section in the Income Tax Act, Section 7B, which makes provision for the matching of timing of accrual and the payment of various forms of remuneration. And essentially what SARS wants is that these types of remuneration will only be deductible when they are actually paid to the employees. Now, the typical types of variable remuneration that are covered is overtime pay, bonus, commissions, travel allowances, advances, leave pay, standby allowances, and reimbursements. Now, the concern that arose, well, there's two concerns. One was that the current rules do not cater for performance-based variable payments in the informal sector, where employees are remunerated on a per unit basis of production. So they wanted to extend that, the variable remuneration definition to cover these kinds of variable payments as well. And then with regard to deceased employees, the timing of accrual of income is usually the date of, prior to date of death, and is at odds with Section 7B. So there are two amendments that have been proposed. The one was to extend the definition of variable remuneration to include variable remuneration that is determined based on units produced. And then to then make provision that Section 7B will not apply when amount is paid to a deceased employee. So an accrual at year end for that kind of payment will still be regarded as deductible. It wouldn't be, it wouldn't be added back in your tax computation. Now, this amendment comes into operation the 1st of March 2023 and applies in respect of amounts accrued or expenditure incurred after that date. Then with regard to the cessation of residency, remember when an individual exits South African tax system because they cease to be resident in South Africa, and that could happen one of two ways. It could happen because the person says, goodbye, I don't want to come back, or alternatively, because of a double tax agreement applying. Now, when that happens, a natural person's year of assessment is deemed to have ended on the date immediately before that person ceased to be resident in South Africa. And the next year of assessment is deemed to commence on the day that person ceases to be a resident. So essentially, in the year that a person breaks tax residency, you actually have 2 years of assessment, right? The concern is that the interest exemption in Section 10(1)(I), the princely sum of 23,800 Rand per person less than 65 years old, and the CGT inclusion of 40,000 Rand, exclusion of 40,000 Rand may be potentially claimed twice, right? In reality, we haven't seen this happen. Our experience of the SARS system is that they cannot accommodate 2 tax returns in 1 year. So generally speaking, a taxpayer only submits 1 tax return that covers both the period before they cease to be resident and after they cease to be resident. From discussions I've had with an individual at SAIT, my understanding is that the process is supposed to be that a taxpayer requests a second return be issued for a year, and it has to do a manual sort of return for the second part of the year when they cease to be a resident. But in reality, this doesn't happen. I haven't never seen it happen in practice. Now, because there is a concern that there may be this double sort of benefit that a taxpayer may receive, there are proposed amendments. The first amendment is related to the interest exemption, and the second, obviously, to the CGT exclusion. And the amendment is to say that those must be apportioned when an individual's taxpayer year of assessment is less than 12 months. So essentially, what they're not wanting to do is give you a double benefit for the period pre and post breaking residency. Now, this comes into operation the 1st of March 2023 and applies in respect of years of assessment commencing on or after that date. Now, with regard to retirement annuity funds, now, at the moment, provided certain requirements are met, a member of a retirement annuity fund can transfer all of his or her total interest in a retirement annuity fund, and they're not part of his interest, where that person has more than one retirement annuity contract. Now, the concern is that while members of retirement annuity funds are restricted in terms of the proportions that they may transfer, members of preservation funds are not similarly restricted. So it's unfair treatment between different types of funds. So the proposed amendments to ease the burden on retirement annuity fund members is firstly that members of retirement annuity funds can transfer one or more contracts to another retirement annuity fund. However, the value of the contracts transferred must exceed 495,000 rands, and the value of the contracts left behind must exceed 495,000 rands as well. So it means that it's only sizable investments in retirement annuities that actually can be moved between funds. This is meant to come into operation the 1st of March 2023 and applies for years of assessment commencing on or after that date. Then moving to corporate tax, one of the major adjustments or amendments that were put through last year was related to contributed tax capital. Now, remember what contributed tax capital is? It essentially is a ring-fenced amount derived from contributions made to a company by holders of shares of a specific class, right? So essentially, it's your share capital that's contributed by your shareholders to the company. And essentially, you reduce your CTC by capital amounts that are transferred back by the company to holders of shares of that particular class. Now, the concern was that, especially where you have different types of shareholders, where you have foreign versus local shareholders, that in some cases, a payment of dividends was being made to local shareholders, but when a payment was being made to a foreign shareholder, a return of CTC was rather being undertaken, right? And remember, we already had a rule in the CTC definition that said what could be returned to a shareholder could only be their proportionate share of CTC. So you couldn't, if you were a 10% shareholder, you couldn't get more than 10% of this contributed tax capital as a return of capital to yourself, right? In 2021, amendments were made because they were concerned about this distinguishing between different different shareholders. And essentially what Treasury wants to achieve is that when a return of capital is made, everybody should participate in it equally. And essentially the first amendment that was made last year, that's what it said. But then it does mean that a specific share buyback could not be accommodated, right? Having considered that, Treasury went back and made the amendment that finally came through in the draft legislation last year. And essentially what the amendment said was that CTC must be returned to all shareholders in the same class proportionately to their shareholdings, right? But general purchase of shares by listed companies were excluded from that measure, right? Now, there were problems with that kind of definition, especially in the context of share buybacks, as I said. So Treasury went back to the drawing board, and in the current year have put through an amendment that will be effective on the 1st of January, 2023. The first thing that they've done is whatever amendments were put through last year have been deleted completely. And essentially what they're saying this year is that when a company transfers an amount, which must not, this must not comprise a transfer of CTC unless all shareholders of the class to which transfers are made within 91 days before and 91 days after that transfer are actually allocated amount of CTC based on the proportional shareholding. So essentially what they're saying is that if you've got return of CTC that has happened over a period of time, each shareholder needs to participate proportionately in that. Now, obviously in this wording, there's still some loopholes which have now been drawn to Treasury's attention. On this one, I expect that there's going to be further changes to the amendment, to the definition of CTC and how the return happens before it's promulgated. Then with regard to Section 45 transactions, remember Section 45 transactions are basically part of our rollover relief rules that allow for the transfer of assets between different types of entities under certain circumstances. Now, in particular, Section 45 applies in a group context and applies to the intra-group transfers of assets. Now, usually consideration is in the form of debt or non-equity shares such as preference shares. And that consideration is deemed to have a nil base cost. In 2020, amendments were made to remove double tax where the degrouping rule also applied. So remember, when you do a Section 45 transaction, it has to firstly be within a group of companies. But where the transferor and the transferee cease to be part of the same group within 6 years, some tax is triggered in the transferee's hands. Right? Now, if you have your consideration having deemed to have a nil base cost as well, and there's a transfer of that loan that arose from the original Section 45 transaction, potentially you have a double tax situation if degrouping has happened already. So amendments were made to remove the double tax where degrouping rule applied as well. Then in 2021, an amendment was made to reinstate base cost when asset was disposed of early. Right? So if you already disposed of an asset, you've triggered the actual CGT on that asset. So you shouldn't really have a nil base cost for the loan that originated from the original Section 45 transaction as well. Now, there's further concerns about this nil base cost rule, and the feeling is that this is punitive in two scenarios. One is when there's an actual disposal of an asset and when degrouping has happened. Now, the amendment that is proposed is that the amendment is to reinstate the base cost of the debt or non-equity shares issued as consideration. So this is now, from a transferee perspective, the consideration that they've paid for the acquisition of the assets under the Section 45 transaction, where there's an actual disposal of assets or degrouping has occurred. This comes into operation the 1st of January 2023 and applies for years of assessment ending on or after that date. Then with regard to the debt benefit rules, there's an amendment. There's a perceived benefit that that taxpayers have got, and Treasury wants to close this loophole. Now, remember what the debt benefit rules apply to. It applies in a situation where a taxpayer owes an amount of debt and for some reason doesn't have to repay that debt. And that could be because the debt is waived or it's settled for less than its face value, or because shares have been issued to settle the debt. Right? Now, various exemptions apply, but where those exemptions do not apply, essentially what you do is you look at what the debt financed. So did it finance the acquisition of capital asset? Did it finance the acquisition of allowance assets or trading stock? And generally speaking, the treatment of the debt benefit follows what the asset that it was used to finance. Right? Now, in a case where a debt was utilized to finance an allowance asset, so an asset on which allowances are claimable, and the asset was actually disposed of in a prior year, right? You've already triggered the recoupment in a prior year on that asset. And now in a subsequent year, you don't have to repay the debt that you took on in order to acquire the asset in the first place. What SARS is saying, or what Treasury is saying, is that in that situation, even though the asset has been disposed of in the prior year, you need to make an adjustment in the current year when that debt benefit does happen. Okay? Now, effectively, the total debt benefit less the recoupment previously recognized, if any, would be subject to tax in the current year. This comes into operation on the 1st of January 2023 and applies in respect of years of assessment commencing on or after that date. Then with regard to debtor allowances, and this is particular to lay-by transactions. Now, Section 24(1) of the Income Tax Act provides that where a taxpayer enters into an agreement, and the effect of that agreement is that the ownership of property will only pass on upon receipt of the whole or certain portion of the amount payable, the full amount of that sale is included in gross income upfront. Now, a debtor's allowance may be claimable under Section 24(2), but the requirement is that at least 25% of the amounts payable under that agreement must become due and payable on or after 12 months after the date of agreement. So essentially what they're looking at is suspensive sale agreements over a fairly long period of time. And under that circumstance, then you can claim an allowance for those amounts that you only need to receive in the future. Now, the concern is related to lay-by agreements, which do not qualify for debtors' allowances, given the fact that the term of lay-by agreements is usually 3 to 6 months. And lay-by has become quite popular in recent times, the economic impact of the pandemic and so on. And a lot of individuals are buying things like school uniforms and stationery and so on a lay-by basis, right? Now, from the seller's point of view, the income from that transaction should be included in income upfront based on Section 24(1). And they're not allowed then to claim an allowance because usually the period over which the remainder of the payments are going to be made is over a short period of time, not exceeding 12 months. To give relief to those taxpayers that do accept lay-by transactions, a new subsection has been introduced into Section 24 to allow an allowance to the seller for any amount that has not yet been received under a lay-by arrangement. So at year end, if you've got a lay-by arrangement, say for 6 months, and you've received 3 months of payments, basically you're taxed on those 3 months of payments, and the 3 months thereafter, basically you're taxed on a receipt basis. So you claim an allowance for those amounts that you only receive in 3 months after year end. This comes into operation on the 1st of January 2023, and it applies for years of assessment commencing on or after that date. Then, very specific amendment for short-term insurers. Now, I'm not going to pretend to be an insurance expert, and certainly IFRS, with the way it's evolved and the number of years since I've done my board exam, I'll be the last one to say that I'm an IFRS expert. But essentially, when it comes to insurers, the IFRS treatment drives the tax treatment. Now, from an IFRS perspective, there's a new statement that's going to be becoming effective on the 1st of January 2023. IFRS 17 will replace IFRS 4. And there's a couple of differences, which I'm not going to go through in detail because I don't think there's too many attendees on the call that are in this industry. But essentially, under IFRS 17, it is expected that some of the provisions that are going to be required from an accounting perspective will be far lower than what they used to be under IFRS 4. And the concern is under the new statement, the taxable income of insurers will increase because of the change in accounting practice. Now, in order to mitigate the tax impact as a result of the methodologies that are proposed between the two different accounting statements, it's been proposed that the difference between the two accounting statements actually be phased in over a period of time. Right? So essentially, you look at your last year, your last tax year before the amendment becomes effective, and you say, well, what was the calculation prior to the amendment coming through? And for that same year, applying the new standard, what is that difference? And that difference is then phased in or taxed over a 3-year period. So from a tax point of view, there is a cash flow benefit. Obviously, if the tax has to be paid, you have to catch up over the 3-year period, but at least from a cash flow point of view, you don't have to hit in 1 year. So this comes into operation at the same time as that accounting statement becomes effective on the 1st of January 2023 and applies for years of assessment commencing on or after that date. Long-term insurers, same issue where the IFRS 17 would replace IFRS 4. But in the case of long-term insurers, the phase-in period is going to be a 6-year period, not a 3-year period. And presumably this is because the level of provisions for a long-term insurer may be higher. But yeah, so essentially similar thinking, but over a longer period of time. Then moving on to mining, there are a few amendments that are coming through related to mining. And it really relates to the 2 amendments that came through in 2021, how that interacts with the mining provisions. Remember, from a mining perspective, mining capital expenditure, there are some preferential deductions that may be claimed on mining capital expenditure, but it's subject to certain ring fencing rules that are contained in Section 36 of the Income Tax Act. Now, the issue was, as far as the assessed loss restriction was which one do you apply first? Do you apply the restriction on the assessed loss brought forward, or do you apply the mining capital expenditure and then apply Section 20, which governs assessed loss brought forward, the utilization of assessed losses brought forward? And in this year's legislation, they've confirmed that you apply Section 20 first, and then you apply the Section 36, so the mining capital expenditure provisions. So you could end up in a situation for certain mines that you end up with a nil taxable income depending on your level of claimable mining capital expenditure. So that's a positive for mining entities. With regard to Section 23M of the Income Tax Act, and remember this is now the provision related to the deduction of interest, excessive deductions of interest, especially where the debt is owed to a person, a non-taxable person in a controlling relationship. Now, the amendment is that basically Section 23M will not be applied to non-producing mining operations that form part of your capital expenditure in terms of Section 36. So at least that's one less thing to worry about when you do your calculation for your mining expenditure that may be claimable. Then a very specific amendment for government grants in kind. Now remember, we've already got quite extensive legislation in Section 12P of the Income Tax Act for government grants that are received in cash, not in kind. And essentially what Section 12P says is the grant is exempted on the one hand, but you reduce the base cost of the asset on which you may claim allowances, and thus reduces the allowances claimable overall, right? So essentially what Treasury doesn't want is double dipping, where you benefit from an exempt amount in the first place, but still are able to claim allowances on the full cost of an asset. Right? But there is a concern where it's an asset to which Section 11E applies, and where an asset is acquired through a grant in kind, right? Now, grant in kind, remember, is not in cash, so you're getting it as almost like a barter transaction or so. And the concern is Section 11E allowances may still be claimable on the value of the asset, despite no expenditure actually being incurred by the taxpayer, because there's a value rule in Section 11E. Now, the amendment that is being proposed is that the wear and tear will not be allowed in assets acquired through a government grant in kind. And this is going to come into operation when the draft tax laws bill is actually promulgated. Then with regard to R&D allowances, remember if a taxpayer conducts qualifying R&D activities and has approval from the Department of Science and Innovation for its R&D projects, that taxpayer may claim 150% deduction on the expenditure actually incurred on those R&D projects, on those approved R&D projects. Now, the sunset date for this deduction or this allowance was October this year. I think it was the 1st of October, if I'm not mistaken. But Treasury is not ready yet with what is going to be its successor. I think there has been consultation with industry members, and the conclusion is that we need to retain R&D allowances in some shape or form, but the actual shape or form has not been decided upon. So what is the best fit for what the government wants to achieve? So in its current form, R&D allowances will continue beyond 1 October 2022 to the 31st of December 2023. And during the budget speech next year, they expect to make announcements on what changes will be coming through. Then on the VAT side, there are a few amendments, and most of them stem from previous Section 72 rulings. So what SARS is trying to get away from is providing rulings to specific taxpayers and rather have things codified in the legislation itself so that there's more certainty provided to taxpayers. So as a result of a lot of rulings being withdrawn, amendments to the VAT legislation was required. And one of them now is related to cross-border leases for ships, aircraft, and rolling stock. In 2020, an amendment was made to codify a previous ruling exempting foreign lessors of ships, aircraft, and rolling stock from registering for VAT in South Africa. And the reason they would have been required potentially to register for VAT in South Africa is because they had assets, actually, they were conducting an activity because they had assets based within the South African borders from which they were deriving income. Now, an amendment was made to enterprise to exclude those foreign lessors if the lessor firstly wasn't resident in South Africa, was not already registered as a VAT vendor, and the lessee has declared the VAT on importation. So where the lessee, so the person actually using the asset within the borders, has declared the VAT on importation, the foreign lessor didn't necessarily need to register for VAT in South Africa. Now, the concern that arose is that a separate lease of foreign-owned parts. So some of these assets require quite expensive parts, for example, aircraft engines, and sometimes those are actually leased as well, so separately to the actual aircraft itself. So the idea here is to amend the scope to exclude from enterprise foreign-owned parts as well. So not only the actual machine itself, but big parts that are also provided on a lease basis to South African lessees. And this amendment comes through on the 1st of January 2023. Then an amendment to make it easier for foreign suppliers. So remember, in terms of our VAT legislation, every person who's conducting an enterprise and whose taxable supplies exceed the threshold of R1 million has a legal requirement to register for VAT in South Africa. And this applies regardless of whether a vendor, as defined, has a physical presence in South Africa. So it's very easy for someone to be regarded as conducting an enterprise in South Africa and not actually have a physical presence here. And typically we see this happen where a foreign entity takes delivery of goods in South Africa and then, either exports it or sells it and so on. But actually because they own goods while it's located in South Africa, it's regarded as conducting an enterprise here. Now, Section 23(2) of the VAT Act requires foreign entities to firstly appoint a representative vendor and open a bank account in South Africa. And sometimes that's not the easiest thing to do, particularly where the foreign entity doesn't have any physical presence in South Africa. Now, in order to make it easier for groups of companies, and usually we see this in a group context where you've got a South African, say, manufacturer who's exporting goods, but on an ex-works basis to its foreign-related parties, and the delivery actually happens in South Africa, the foreign enterprise technically has to register for VAT in South Africa and as an exporter. So the amendment now is to allow a single local resident group company to register a single branch on behalf of all non-resident group companies. So if you've got a South African company that is exporting, for example, to maybe 10 group companies, they can register a single branch under the South African entity to take care of all the administrative requirements for the fellow group companies. And this comes into operation on the 1st of January, 2023. Then with regard to flash title sales, now again, going back to the definition of enterprise or when registration is required, every person who's conducting an enterprise in South Africa and your taxable supplies exceed a million threshold, they have a legal requirement to register for VAT in South Africa, regardless of the fact that you don't have a physical presence. Right? Now, some non-resident entities, and usually these are qualifying purchases under the export regulations, take ownership of goods in South Africa and immediately on-sell the goods to non-resident customers on a flash title basis for export by the customer. Now, the concern about the administrative compliance challenges by foreign entities with no physical presence in South Africa, and remember, it's not like SARS is really going to collect VAT from these individuals. It's really, these are generally going to be zero-rated sales. So it really is a compliance requirement that these guys need to be on the register. So an amendment has been proposed to exclude as an enterprise the activities of a qualifying purchaser who is a non-resident, who's also not registered for VAT in South Africa, who merely takes flash title ownership of goods. But obviously documentary requirements need to be met. So just to be aware that this comes into effect on the 1st of January, 2023. Then quite a big thing for particularly banks, repossessions. The documentary requirements around claiming VAT on repossessions. Right? Now, if you repossess goods under installment credit agreement, and remember in the VAT Act, an installment credit agreement could be a finance lease arrangement or it could be an installment sale agreement. Right? The VAT Act deems the repossession to be a supply from the borrower to the lender. And this is in order to permit the lender, who is a registered vendor, to recoup some of the output tax paid at the outset of the agreement. Because remember, when an installment credit agreement is entered into in the first place, there's an output tax element to it. Right? Now, the supporting documents for the input tax credit is either a tax invoice issued by the lender, so a self-invoicing kind of scenario, or the VAT 264 declaration. Now, where the debtor used the goods in an enterprise, so in the course of furtherance of an enterprise, the VAT Act allows the lender to self-invoice, right? So if the installment sale agreement or the finance lease agreement is with a company that's conducting an enterprise, is registered for VAT, the lender can issue its own invoice and claim VAT, input VAT based on that self-invoice. The problem relates to those repossessions from individuals, particularly, that are non-vendors and vendors who do not use the goods in the course or furtherance of an enterprise. Then the VAT Act requires the lender to obtain and retain a declaration from the debtor in the form of this VAT 264 form. And the concern here, and I think this has been raised quite a bit by the banks, is that a debtor who is facing a repossession is unlikely to be cooperative. It's usually an antagonistic relationship and is unlikely to sign one of those VAT 264 forms. So in order to mitigate the damage or the risk to the lender, there's an amendment to Section 20. So remember, Section 20 is the provision that deals with tax invoices. And essentially, the amendment is to stipulate the documentary requirements for the lender to substantiate the entitlement to make the relevant VAT adjustment. So essentially, they're changing the rules to move away from the VAT 264 form move more to a self-invoicing kind of system for repossessions. And this comes into operation the 1st of January, 2023. Then lastly, I want to just deal with a few amendments on the carbon tax side. Now, carbon tax is something that all of us will be impacted by, but we'll only see it in the cost of the goods that we acquire. The number of taxpayers that are actually subject to carbon tax and have to pay carbon tax is, well, I won't say a handful, but it's certainly not in the thousands. It's in the hundreds of taxpayers that are subject to carbon tax. The first thing that to note is the tax rate change. There's quite steep changes or steep increases in carbon taxes that are being proposed. In the period 2023 to 2025, The proposal is to adjust the carbon tax rate by $1 a ton in the first year, $2 per ton in the second year, and $3 per ton in 2025. Right? So, and if you think of the rand depreciating, I mean, you could end up having an increase per ton of 60 rands. Now, bearing in mind that the carbon tax rate per ton at the moment, or what it was in 2021, was 134 rand per ton. So these are big increases that are proposed up to 2025. From 2026 to 2030, essentially what's going to happen is 2026, the carbon tax rate is going to be fixed at $20 per ton. And that's going to progressively increase by $2.50 until we reach $30 per ton in 2030. Now, $30 per ton is significantly higher than the $134 rands per ton that was being accounted for last year. In order to calculate the rate, the actual rate in rand, the average exchange rate must be used to determine the rand equivalent. Right? So not only do we have a higher carbon tax rate, we also have foreign exchange risk related to the carbon tax rate. So it's going to be difficult, especially in a scenario where the rand depreciates. It's going to be very difficult for taxpayers to manage what the carbon tax exposure is going to be. And this comes into operation the 1st of January 2023. I saw a news article this morning where Cecil says if these rates come in as they proposed, they're probably going to be out of business by 2030, which is quite a frightening thought that it could have that big an impact. I think the bottom line is the tax is there to force change, and it's there to force taxpayers to become more carbon efficient. The problem is, I think the technologies are not that cheap. It's quite expensive to change, and I don't think our economic situation helps much either. Then other amendments related to carbon tax. First, the next amendment relates to the extension of the first phase, which was meant to end at the end of this year. It's extended to 31st of December 2025. And there's a few things that come with that extension of that first phase. Firstly, Section 12L, the energy efficiency incentive has been extended as well. Remember, these are energy efficiency projects undertaken by taxpayers. And for every kilowatt hour that you save, I think it's about 95 cents that you can claim as a once-off deduction in that year of assessment. Obviously, subject to having the necessary readings by your various, the engineers that actually perform those kinds of readings and so on to prove that you've actually saved that much of energy. Then, with regard to electricity price neutrality, there's a commitment extension. So at the moment, electricity generators, so those taxpayers that generate electricity can deduct the payment of the electricity levy and additional purchases of renewable energy from their carbon tax liability. Right? And for that, they use the renewable premium rates for different technologies as gazetted by the Minister of Finance. Now, what's the amendment is to extend that electricity price neutrality to 31st of December 2025, which is a welcome change. Then extending this electricity price neutrality to other taxpayers, so not only electricity generators. So the idea is to extend the application to taxpayers generating their own electricity from fossil fuels. And qualifying activities on which this neutrality applies is extended beyond energy industry activities, so your IPC CC code A1A1, to include manufacturing industries and construction, which is IPCC code 1A2. Now, I know it sounds like gobbledygook, but those taxpayers that are operating in these industries know which industries they fall under. And if this amendment operates the way I think it does, it means that those taxpayers that are in manufacturing industries and are generating their own electricity to be used in their production process can benefit from this electricity price neutrality and being able to deduct the cost of well, I won't say cost, but they make deductions related to the purchases of renewable energy. Let's say they substitute burning of fossil fuels with solar power as an example, they should be able to reduce their carbon tax liability as a result. Then one change that's not in favor of taxpayers related to the sequestration of carbon emissions. Now, in 2021, amendments were made to limit the carbon sequestration deduction to forestry and harvested wood products. Now, remember, Sequestration is a scenario where you grow a forest and you say, well, I'm absorbing all this carbon dioxide from the atmosphere. And as a result, I can get a deduction in my carbon tax calculation. The concern is that taxpayers are claiming a deduction for carbon sequestration, but they themselves are not conducting that activity. It's somebody else who's doing that. And the problem is policing that and making sure that it's legitimately claimed. So the amendment that's come through this year is that they want to limit the deduction for sequestration to the taxpayer's own activities. So if you want to claim a deduction for sequestering carbon dioxide in trees, you need to be actually growing the trees yourself. You can't be buying credits from somebody else. So where I see this is going to benefit is mainly those guys that are in the paper industry, or in the forest, those kind of industries. It's very difficult for someone who's, for example, making cement to actually run a forest and also sequester carbon emissions in that form. Then I've got, this is my last slide. I've got one question which I'll deal with now. So the question is, will the changes to Section 28, and this is in the case of short-term insurers, mitigate the increase in taxable income brought about by IFRS 17 be optional? It seems quite onerous to have to calculate the effect in terms of two methodologies for a period of time. So the way I understand this to work is that in the year before that amendment comes through, you will work out for that year. And you would have had to do it for your financial statements anyway. On the old method, you would have calculated your provisions, and under the new method, what it would have been for that year. And it's that difference, which doesn't change, that gets phased in over a 3-year period. So it has to be done once off. And I think for the purpose of financial reporting and restating financials to the right, so they're consistent, taxpayers will have to do this anyway for reporting purposes. So I stand to be corrected, but I don't think it's going to be that onerous to actually calculate this and apply it in practice, because I think those taxpayers would have to do it for financial reporting in any event. And with that, I'm going to hand over to my colleague Anushka. Just give us a moment to change over. We're showing our age, and hopefully there's no glitches with the changeover to Anushka.
Thank you, Yasmeen. And good morning to everyone. Before we get into the detail, I thought I'll share this cartoon with you that I've come across. I think it applies to SARS as well. Okay. I'm going to start with the proposed amendments in the draft Tax Administration Laws Amendment Bill. Now, there have been quite a few proposals in the draft bill. I'm only going to cover a few that that we thought will be of interest to the audience today. The first proposal relates to the registration of non-resident suppliers of electronic services. So now currently, a non-resident supplier of electronic services has to register with SARS as a vendor at the end of the month where its taxable supplies exceed 1 million rand, and there's no exception to this rule. There is a rule in the VAT Act that relates to vendors other than suppliers of electronic services, whereby they do not need to register for VAT if their supplies exceed 1 million rand due to abnormal circumstances of a temporary nature. But that unfortunately doesn't apply to non-resident suppliers of electronic services. The proposed amendment is to insert an exception to the registration rule in this regard, which is a welcome, proposal for these non-resident suppliers. It will, have ease their burden to register with SARS as well as to file returns, and it will also ease SARS's burden to go through this whole process of registering someone who may not need or may not have some, taxable supplies in the future. Then the next proposal deals with understatement penalties, and relates to the employment tax incentive. So the employment tax incentive program was introduced in about 2013, with the aim to promote employment for youth. And over the past few years, there have been quite a number of schemes that taxpayers have entered into, whereby they have been claiming the ETI on employees who don't, or on persons who don't qualify as an employee as defined in the Employment Tax Incentive Act. Now, SARS has caught on to these schemes, and they have made changes to the definition of employee in the ETI Act previously. And we're seeing an uptake in the number of audits SARS are conducting on the ETI, the ETI claimed. However, when SARS raises assessments for the ETI improperly claimed, because of the wording in the Tax Administration Act, SARS actually can't impose an understatement penalty. So in order to curb the ETI abuse even further, the amendment that will come into effect is that the ETI Act will be amended in order to facilitate the imposition of understatement penalties on ETI reimbursements improperly claimed. Now, we would recommend that if you have entered into these sorts of schemes and haven't been attacked by SARS yet, maybe consider regularizing your ETI claims in order to avoid understatement penalties being raised in the future. Then, still on the Tax Administration Act, the next proposed amendment relates to the tax compliance status system. Now, over the last few years, SARS has noted an increase in the abuse of the TCS system. Taxpayers who are actually trading or economically active, they tend to file a null return or file inaccurate returns just to meet that requirement of no outstanding returns so that they remain compliant on the TCS system. To curb this abuse, SARS, National Treasury has proposed 2 amendments to the TAA. The first amendment is that the Tax Admin Act be clarified that SARS actually has the right to revoke third-party access to a taxpayer's TCS, should it be suspected at any point in time that the taxpayer's TCS is in question due to fraud, misrepresentation, or non-disclosure of material facts. Taxpayers will be given 10 days to respond to SARS's concerns before this third-party access is revoked. In addition to this, the next step that has been proposed is that on the TCS of the taxpayer, it will be indicated that the taxpayer is a newly registered taxpayer between the dates the third party has access to the system and the date that the taxpayer reaches, the date for the first submission of the first return or the first payment it's required to make in respect of any taxes for which he's registered for. In this instance, the user of the TCS will be able to bear in mind that the TCS provided them is not based on actual returns or payments made, and that further due diligence may be required before relying on that TCS. Then moving on to the Income Tax Act, and the next amendment deals with Section 64 and the refund of dividends tax. Now, Section 64L of the Income Tax Act deals with refunds from a company which has withheld dividends tax and provides that if the amount refundable exceeds the amount of dividends tax withheld by the company during a period of at least 1 year after the amount became refundable, the company may recover the excess from SARS. However, no similar provision is found in Section 64M pertaining to regulated intermediaries. Now, in terms of the current 64M, the amounts that are refundable must be refunded from an amount of dividends tax withheld by the regulated intermediary going forward. Now, a regulated intermediary's clients are usually, corporates, and that the process of actually getting this refund back could take a few years in some instances. So the proposed amendment is to basically align the position of the regulated intermediary with that of the company, and the regulated intermediary would be able to, recover the excess dividends tax from SARS. Then when it comes to the Customs and Excise Act, currently there is no provision in the Act that enables SARS to issue advance rulings, unlike our, the Income Tax and VAT Acts. So a welcome amendment is that the provisions in the Customs and Excise Act will be updated to include provisions to enable SARS to issue advance rulings. Moving on, we are going to look at the Draft Revenue Laws Amendment Bill. And the draft bill, which was released in July, contains the much anticipated two-pot retirement system. Now, in terms of the current rules that are applicable to a pension and provident fund, members may only access their retirement savings upon withdrawal or retirement. Now, in terms of financial distress, sometimes members tend to resign from their employment merely to access the funds available in their pension or provident fund. Now, preservation funds and retirement funds, on the other hand, the members may only access the funds upon retirement. So the draft bill aims to encourage retirement savings while still giving members access to a bit of their cash when they need it, due to unforeseen circumstances. So the main amendments that are proposed in the bill is from the 1st of March next year, all pension, provident, preservation, and retirement annuity funds will be obliged to allocate contributions paid to them to a new retirement pot and a savings pot. Now, up to 1/3 of these contributions paid to the retirement fund can be allocated to the savings pot, while the balance of the contributions has to be allocated to the retirement pot. In terms of the tax deductibility, the retirement fund contributions will still be deductible up to the current caps, which is the greater of 27.5% of taxable income or 350,000 Rand per annum. But where the contributions are in excess of these caps, those excess contributions has to be allocated to the retirement pot. Now, from 1 March 2023, members of retirement funds will be entitled to withdraw an amount of not less than 2,000 Rand from their savings pot once a year without having to resign or withdraw from service or retire. Now, this is quite a nice change, and they will still be allowed to continue working without having to stress about accessing their funds. But what's important to bear in mind is that any withdrawal from the savings pot will be added to taxable income in the year of withdrawal and will be subject to the normal tax rates. So it won't be subject to the withdrawal tax table rates like the current lump sum withdrawals are taxed. Now, on retirement, if there are any funds available in the savings pot, the member can choose to either transfer those funds to the retirement pot or to withdraw the available balance in cash. Now, any amounts that have been allocated to the retirement pot cannot be accessed at all before the member reaches retirement age. On retirement, whatever the total value of that retirement pot has to be paid in the form of an annuity or a monthly pension. However, if that value in the retirement pot is less than the proposed minimum amount of 167,500 Rand, the value may be taken as a cash withdrawal. Now, despite this being called a two-pot system, there is a third pot, which is known as the vested pot. And this vested pot will hold all the accumulated retirement savings up to 28th of Feb next year. So whatever contributions and interest that has accumulated in the funds before 1 March will have to be valued at 28th Feb 2023 to determine this vested pot. The funds that are in the vested pot will remain subject to the current conditions. So in other words, members of a pension or provident fund will not be able to withdraw savings from the vested pot before retirement or before resignation. Now, in the case of divorce orders, the division stipulated in the divorce order will apply to all three pots. And if a person ceases to be tax resident, they can fully withdraw from all three pots if they've ceased to be a tax resident for a period of at least 3 years. But the withdrawals will be taxed as follows. So the vested pot will be taxed in accordance with the legislation pre-1 March 2023. The savings pots will be included in gross income and will be taxed at the normal tax rates. And the retirement pot will be taxed in accordance with the lump sum withdrawal tables. And that's it from me. I've kept it short and sweet. I'll now hand over to Bruce, who will take you through recent tax cases. Just give me a second.
Good morning, everyone. My name is Bruce Bosch. I'll be taking you through the recent tax cases over the last year. Just for a little bit of humor before we start, SARS surprising us by going under the radar. My response to this is, SARS, you sneaky little sly bandits, robbing from the tax compliance and giving to and allowing the tax non-compliant to get away with a lot of skullduggery. And we see this especially with regard to the understatement penalties that have been imposed in terms of our recent experience, where they just don't apply their mind, or they're just looking for easy amounts of cash by imposing ridiculous understatement penalties in respect of compliant taxpayers. So they don't believe in any honest mistakes that are made. It's just treating everyone as criminals at the end of the day. So yeah. So in terms of the recent cases, the first case that I'm going to deal with is income tax case 25042, which is a tax court case, which was handed down in Bloemfontein. Involved a property investment and management company which raised loans to finance their property development and to acquire shares in a rate. So the income that the company would have earned would have been rental income and management fee income. So in raising the loan finance, the company incurred once-off raising fees, debt originating fees, as well as restructuring fees during the 26 year of assessment. So the question to be answered was whether the finance charges levied in respect of the loans constituted interest for the purpose of the Income Tax Act. And the specific provisions that deal with the interest and finance charges was Section 24J, as opposed to Section 11A of the income tax, which deals with your other deductions under the general deduction formula. So once the taxpayer had submitted his 2016 tax return, there was a change to the wording in Section 24J and the substitution of the word related with similar. So that had an effect on the interpretation of whether on the deductibility of these raising fees, debt origination fees, as well as restructuring fees. So SARS, in their sly and sneaky way, tried to use the changes in the wording to try and bring it into their argument to disallow the 2016 fees that have been incurred. The reason why they tried to do it because the change was made on the 19th of January 2027 and only came into effect on and after that date. So it could never have applied to the 2016 year of assessment. But SARS in their sneaky way tried to bring it in. However, the judge automatically said no to them because, and why, the reason why is that Section 81 of the Constitution creates a presumption that unless a statute explicitly determines the commencement date, the act in issue becomes in force upon promulgation. So the act only came into effect and the wording only change will only happen on the 19th of January 2017 onwards, and therefore could not apply to this 2016 year of assessment. So that SARS was ruled out in terms of using the changes in the amendment to support their argument. So what in terms of section 24J2, the interest is only deductible whether or not the interest is seen, the interest in terms of is only deductible whether or not the interest is seen as being capital in nature. So section 24J2 doesn't refer to like section 11A, whether it's capital in nature or revenue in nature. The test is whether it's incurred in the production of income or part of your trade. So those are the two requirements that need to be met. And the court held that all those fees were incurred in the production of the income and as part of parcel of trade and therefore were deductible. The company also had acquired shares in the rate to protect their income stream. And as we know, the income from a rate is taxable in the hands of the recipient. And therefore, all those fees that incurred in respect of raising the finance to acquire those shares, those upfront fees are also regarded as being incurred in the production of income in the parcel of trade and therefore were deductible in the hands of the taxpayer. Okay. Then the next case is income tax case 14213, which is also a tax court case decided in the Gauteng division. And this case was involved a private investment holding company, which assets comprise of its unlisted shares in its subsidiary, loans and advances to those subsidiaries, and cash. So the income that it would have earned would have been dividends in the form of dividends from its subsidiaries, interest on the loans that have been advanced to these subsidiaries, and positive bank balance, interest from the cash that it would have invested. So what when SARS looked at the income tax returns of the taxpayer, realized that there was a large assessed loss that had been created. And the assessed loss was created as a result of the interest expense exceeding the interest income in that entity. So what SARS did, and what the practice was in terms of practice of 31 was to limit the amount of interest deduction to the interest income that is physically earned. So in the case of this company, they had earned investment income of 34 million and incurred interest expense of 68 million. So SARS limited the deduction of the 68 million to the 34 million. So there was in a neutral position. So there's no taxable income to pay on the interest income at the end of the day. So in disallowing the balance of that 30, my maths is not too good on this occasion, 33 million, that would be basically a loss at the end of the day, and it would not be able to be a permanent loss to the taxpayer because they were not able to claim it as a deduction. The taxpayer tried to argue that it was a money lender with specific purpose of making a profit from on lending towards in respect to the funds that were borrowed and on lent to its subsidiaries. The questions to be answered by the tax court were in respect of the interest that sought to be deducted by the taxpayer. Was it incurred in carrying on a trade? And was the interest incurred in the production of income? And the third was whether SARS was justified in imposing understatement penalties. Okay, we're going to deal with the two situations as they form part of the basis of the case. So the courts looked at the solar glass finance company case, where it was held that there had to be an intention to lend to all and sundry, provided that they were, from the taxpayer's view, eligible. So you couldn't just provide only to the companies within your group of companies for you to qualify as a money lender. It needed to provide it to all and sundry at the end of the day. So in this case, you can see that it was providing only to its subsidiaries and therefore would not be regarded as a money lender. The court then went on to consider whether the taxpayer had a profit motive, profit-making motive. So the taxpayer had borrowed monies at a higher interest rate and on-lent the same amount of monies to the subsidiaries in the group at lower interest rates or interest rates equal to the rate at which it had borrowed. So from that indication, you can see that there's no profit-making motive by that entity at the end of the day. You can see from if it was a pure commercial transaction with independent third parties involved, you would never borrow money at a high interest rate and lend out at a low interest. It doesn't make commercial sense. You would be out of business within a couple of days. Also, the lack of terms attached to the subsidiary loans. So no formal or contract agreements in respect of these loans, determining the manner in which the amounts we pay, the interest, in terms, the repayment terms. So we can see that it didn't make any commercial sense in respect of the transaction. And therefore, the court held that it could not be reviewed as an activity of carrying out the intention of making a profit at the end of the day, and therefore stated that it could not be carrying on a trade. So the trade element was not established and was struck down by the courts. Then for the production of income, the court analyzed the entire transaction and lending arrangements of the company, and it could not be shown by the taxpayer that it had made that was making a profit, was incurring making a profit for the purpose of producing, and it could not be established that it could not produce income at the end of the day. But rather, the intention of the overall structure was to give lower interest borrowings to their subsidiaries, which will show higher taxable income in their hands, and then pay huge dividends back to the holding company, which would be in the best interest of the investors at the end of the day. So from a commercial perspective, you can see that there is no profit-making intention, and the court held that there was no intention to produce income at the end of the day. Therefore, SARS was justified in limiting the actual interest expense to the interest income earned. And this is you see this a lot in holding companies where they're providing interest loans to their subsidiaries or interest-free loans to their subsidiaries, but are incurring interest expense as well. So yeah, so it's a thing to look out for. And practice note 31 has been in existence for quite some time, so taxpayers should be aware of what SARS is looking for. Okay, the next case is SARS versus Capitec. This was the SCA case. So Capitec provided unsecured loans to its customers. Capitec claimed an input tax in relation to the unsecured lending business. Capitec provided loan cover for these unsecured loans for no charge or no consideration. The loan cover was underwritten by an insurer and the premiums were paid by Capitec Bank. So effectively, Capitec Bank had granted their customers unsecured loans. So on the basis that the customers had either been retrenched or deceased, Capitec would then make a claim against the insurer and then offset that insurance claim against the debt that was owed by the customer at the end of the day. So the contract, you can see, was between Capitec and the insurer itself. Okay. So Capitec, in this instance, received proceeds in terms of its underlying insurance proceeds. So when the customers were retrenched or deceased, they made a claim. Capitec then claimed a notional input tax in terms of Section 16.3C of the VAT Act. And what does Section 16.3 say? And this is what was used in coming to the decision by the court. Section 16.3C of the VAT Act provides for deduction of an amount equal to the tax fraction of amount that is made to indemnify another person in terms of a contract of insurance. Remember, the contract of insurance was between Capitec and the insurer itself, but only if the contract of insurance is a taxable supply. So the only person that would be entitled to the indemnity, the claim, would be the insurer itself, because when the insurer received the proceeds received the monthly installments from Capitec for the insurance of the loan, it would have shown that there's output tax on its side. And when it paid that insurance claim out to Capitec, it would have been entitled to claim it under that section, under Section 16.3C itself. So, and you can see that Capitec was never the insurer in this case at the end of the day. It was the insurer who was contracted with Capitec. So SARS disallowed the input tax claim by Capitec in respect of the section 16.3C claim. So Capitec contended that since it was a borrower, since the borrower had to pay interest and fees, consideration was provided for the loan cover. So Capitec tried to argue that by paying the interest, which they tried to say that the fee in respect of the cover would have been included in the interest charge by charging higher interest, would be included in that interest fee. But I mean, even if the interest is higher, interest will still remains interest and would be exempt. It also tried to argue that the fees that were paid by the customer when they were on a monthly basis for the loans would have been included there to cover the loan cover. But if you look at the fees, that was regulated by the National Credit Act, and those are the maximum fees. You know, the 57 Rand that you pay a month on your loans. It was that fee, and that fee was covered by what would have been covered by the National Credit Act, and that was a maximum fee that they could charge for that service of 57 Rand. So they could never. So it was argued that 57 Rand could never include the part of the Capitec's contribution in respect of the client's contribution in respect of those fees. Okay. It was also argued that alternatively, if the loan cover was for no consideration, it would still be levied at a fee termed the taxable supply in terms of section 1023 of the VAT Act. And we'll see that later in terms of the judgment that was handed. Section 23 relates to the value of a supply, and it doesn't change the nature of the supply at the end of the day. So the court had to look at various definitions in the VAT Act to come to its conclusion. And one of the definitions was a taxable supply, which is defined in terms of section 1 of the VAT Act and means any supply of goods or services which is chargeable with tax under the provisions of section 7.1a. And section 7.1a provides that subject to the exemptions provided for in the Act, the VAT is levied on the supply by any vendor of goods or services which are supplied in the course of furtherance of an enterprise carried on by the vendor. Very important, that it must be carried in the course of furtherance of an enterprise. What is an enterprise? An enterprise defined to mean, in the case of a vendor, any enterprise or activity which is carried on continuously or regularly in the Republic and in the course of furtherance of which goods are supplied for by any person for consideration. So there must have been consideration. So Capitec eventually, after trying to argue, they eventually conceded that there was no consideration. So if there is no consideration, you go back to think there's no enterprise. If there's no enterprise, there's no taxable supply. So on that basis, I think the link in terms of what the nature of the activity would have been in respect of the input tax claim. So they also looked, the courts also looked into what they said in the Torves case, where the vendor carries on the business of providing financial service, that remains its business. So it cannot change the business. That is the business, the business of money lending, and which is an exempt supply. The fact that there may be some taxable fees that are earned in the course of the business, which can be carved out, does not convert what is in essence an exempt supply or an exempt activity into a taxable supply or a taxable activity. So even if you're charging a small portion of a fee, a taxable fee, it doesn't change the nature of the supply or activity at the end of the day. Okay. But thus, the fact that the fees charged by Capitec for its services carry VAT does not mean that the activity of supplying credit losses loses its exempt nature at the end of the day. So if you can remember in terms of the VAT Act, so where you have expenditure which is incurred for the purpose of making taxable supplies, which are your zero rated and standard rated supplies, you can claim the full input tax in respect of those supplies. Where you're making exempt or non-supplies, no input tax can be claimed in respect of those supplies. However, in this business, and you can see they've been charging a fee, a taxable fee. So the nature of the activity or the nature of the business would be rather of a mixed supply basis because they're providing both taxable supplies in the activity and they're providing exempt supplies, which is a provision of credit at the end of the day. So the activity, in my view, would have been regarded as a mixed supply activity. So the SCA also stated that the fees charged for the provision of credit, if not paid immediately, become capitalized and added to the outstanding loan, which rendered them exempt. So where the customer defaulted, the fees that were charged, the 57 Rand fees that were charged, would have been capitalized, and their SCA decision was that it would change its nature from being a taxable supply to an exempt supply. However, this contradicted with the case that they had previously made in the judgments on, which is the Standard Bank case, in which they ruled that when an amount is debited to a customer's account, it does not lose its character at the end of the day. So there is a contradiction in that, and our understanding is that it should never lose its character, or it should never be changed from a taxable supply to an exempt supply if it's capitalized at the end of the day. I mean, it's just an accounting transaction of capitalizing the fees at the end of the day. So, yeah. The court further went on to hold that Capitec was in the business of providing credit, which is an exempt supply, which is an undisputed fact, and not in the business of providing insurance cover. So the insurance cover would have been provided by the insurer and not by Capitec at the end. So that was its business, and it was an exempt supply. And the provision of credits is an exempt financial service in terms of Section 12, read with Section 2 of the VAT Act. And the loan cover was supplied in the course of making an exempt supply and was therefore not deductible by Capitec in its VAT returns. And then also looked at 2020, Section 23 of the VAT Act, and also stated that it's merely a valuation rule and does not determine whether a supplier will change its character from a taxable supply to a non-taxable supply. Our concern is around the apportionment of the input tax in the game of the mixed supplies in respect of the insurance premiums and other costs that would have been incurred in respect of their business activity, because, as I said, it made taxable supplies in the form of the fees, and it also made exempt supplies in terms of the loan finance that was being provided to its customers. Okay. In another case, also involving VAT, is Mukuru Africa versus SARS, and this was also a SCA judgment. Mukuru was a registered vendor, is a registered vendor under the VAT Act, and it commenced its business on the 1st of February 2014. It made both taxable supplies and exempt supplies in the course of carrying out its business, and it incurred expenditure in respect of making those supplies. So the issue before the SCA was whether SARS was precluded by the provisions of Proviso 3 to Section 17(1) of the VAT Act from granting approval for the use of the so-called transaction count ratio by Mukuru with retrospective effect for the period 1st March 2014 to 29th of February 2016. So on the 20th of February 2017, Mukuru applied to SARS for a ruling under Sections 41B of the VAT Act. So it probably realized there was a VAT leakage from its system and was not claiming the correct amount of input tax in respect of the nature of its business when taking into account its taxable suppliers and exempt suppliers and non-suppliers at the end of the day. So it applied to SARS for the ruling. Section 17(1) of the VAT Act does not stipulate the ratio. It doesn't stipulate the ratio that must be used for what ratio should be used. This is determined by way of a ruling from SARS as contemplated in Chapter 7 of the TAA or Section 41 of the VAT Act. So the ratio, you can apply to SARS for a ratio depending upon your facts and circumstances, and they will provided you put all the facts and circumstances in with your calculations, they can grant you a ruling and an apportionment ratio to be applied in respect of your mixed supply expenses. So when SARS issued the ruling to Mukuru on July 2018, the ruling was in favor of Mukuru and allowed it to claim its input tax in respect of its mixed supplies on the apportionment ratio that would be provided to Mukuru by SARS in respect of that ruling. However, if you look at Section 17(1), Section 17(1), read with the TAA, sections of the TAA, give us a default position. So the default position is if you do not have a ruling from SARS in respect of your input tax to be claimed in respect of your mixed supplies, the standard turnover method must be used in the absence of a SARS ruling, and this is the only position that can be applied if you do not have a SARS, if you do not have a ruling from SARS. So the SCA, so when Mukuru applied for that ruling and was granted the ruling in July 2018, it could only, in terms of the legislation, it could not use that ruling retrospective from the first day it entered into business, which was in 2014, up until the end of the preceding financial tax year of assessment at the end of the day. So it applied for the ruling on the 20th of February 2017. Sorry. So SARS, in terms of Section 17(1), would only allow it to go back to the period 1st March 2016, and then carry that ruling forward to allow it to claim its input tax in respect of the ruling that has been provided by SARS. Any period prior to the 1st of March 2016, it would be the default method that would apply, and that would be the standard turnover-based method. And that was the basis of the judgments at the end of the day. Okay. So in terms of legislation, SARS has no power to make a retrospective adjustment in respect of the apportionment ratio to be used where no application was made by a taxpayer to get a ruling from SARS. Okay, so in any event where you don't have a ruling, you must apply the standard turnover method. If SARS has granted you a ruling in a tax year, you need to go back to the beginning of that tax year, and then apply that ruling from the first day of that financial year going forward at the end of the day. Okay. Then the next case is also an SCA case, is a SARS versus the Spur Group. Then the court was called on to decide whether there was sufficient close causal link that existed between the respondents' expenditure in respect of a contribution of 48 million and its income producing operations, and whether it qualified as a deduction in terms of Section 11A of the Income Tax Act. The second thing was also whether it was called on to decide whether Section 99(1) of the TA Act applied, and whether SARS was precluded from raising assessments in respect of periods that had become prescribed. So a little background to the facts. Spur Group, together with its holding company, formed a share scheme, a trust for its key employees. The Spur holding company was the sole capital and income beneficiary. Later, the trust deeds had changed and was amended to ensure that the participants, the key employees, benefits from the dividends received from the trust. However, Spur Holdco remained the sole capital beneficiary of that amount. So it could only be the 48 million, could have benefited from the 48 million. That was Spur Holdco. So in December 2004, Spur Group contributed 48 million to the trust. The Spur company then used the 48 million to invest in another company and obtain preference shares from that company. So the respondent claimed, Spur Group claimed the 48 million as a deduction against its income in its tax return in terms of Section 11A. So the SCA looked at it and determined whether they regarded the deductibility of the contributions. So the SCA found that the participants, the employees, neither benefited directly or indirectly from making the contribution itself. So they didn't benefit from the 48 million. The benefit would only be achieved by the holdco at the end of the day. So effectively, there was no benefit for that contribution itself, not the fruits of the benefit, the actual contribution itself. So there was no benefit that would have been received by the participants from the actual contribution. And the chief financial officer and the director had also testified that the scheme did not permit the participants to share in the 48 million rand contribution. It was also confirmed by the tax practitioner that it was always the intention that the Spur Group will never be able to transfer. It was never the intention to transfer that 48 million rand to the participants, and would remain for the benefits of the Spur Group at the end of the day. So you sat basically with a contribution of 48 million rand like a capital contribution to the trust for no benefit or that would have been received in respect of the trust. In respect of the company itself at the end of the day. So the SCA held that the contribution was not sufficiently closely connected to the business operations of the respondents, such that it would be proper, natural, and reasonable to regard the expense as part of the respondent's cost in performing such operations at the end of the day. So therefore, the deduction was not allowed. Then in terms of prescription, the SCA found that the Spur Group had not made truthful disclosure in its tax returns for the 2005 to 2009 years of assessment in respect of the contribution that was made. The true position was only picked up in the 2019 audit, in the 2011 audit, sorry, and that persisted up until that point in time. The SCA held that there was a misrepresentation and non-disclosure by the respondents, which caused the commissioner not to correctly assess those 3 years prior to the regional assessments being issued. So the returns were regarded as open, and SARS was granted the permission to review those assessments and make adjustments or assessments in respect of those assessments that would have been prescribed. Very important to note that tax returns are not just the formality of entering numbers and ticking boxes. You need to apply your mind properly, or you could cause the tax return never to be prescribed. So it's not just a formality. You need to apply your mind, and you need to ensure that whatever's entered into that tax return is correct and meets your facts and circumstances of the business at the end of the day. You could also land up in jail for incorrect disclosure on your tax return. So it's one of those things that you need to take into account as well. Practical examples for individuals, your assets and liabilities, where assets and liabilities are required in your tax return, you do not disclose it. That means it's incorrect disclosure to SARS, and those returns will remain open. Questions answered incorrectly on the tax return, incorrect disclosure of amounts in your tax return, and incorrect fields, amounts recorded in incorrect fields, that could result in tax returns not becoming prescribed at the end of the day, and open up for SARS to attack those returns when the 3-year period has expired. And that's my presentation. Thank you very much.
Thank you very much, Bruce. That was certainly very interesting. My name is Mfundo Dubula, like my team has indicated, and I'll be taking you through what, in my view, I think is one of the most interesting aspects of this entire presentation that we have. I'll be taking you through the recent developments at SARS, and what you'll pick up is that the general theme from the entire presentation is that SARS has been trying to ensure that they make it as, in fact, from the past 2 to 5 years, in fact, they've been trying to do that, to make it as easy and efficient as it can be to be compliant with your taxes, both from your side and then from their side as well. And by that, I mean they have been investing a lot in their technology and trying to improve their processes. So you'll pick up that from the training that from the presentation that I'll take you through. And then on the other hand, or rather on the opposite end of the spectrum, they're also trying to ensure that they make it as punitive as they can to be non-tax compliant. So if they find you trying to dodge tax or to engage in some very unsavory types of practices, then they want to ensure that they stop that as soon as possible. And to begin with, I will start off on a very high note, and Yasmeen already touched on this earlier when she was doing her part of the presentation. And in my view, I think if you take nothing away from this session that I have, it's the important one is the fact that you will no longer have to do those very complicated IT14SD reconciliations with effect from tomorrow. So this is a very nice improvement or enhancement or change that SARS has been making. So from tomorrow, you will no longer have to do IT14SDs where SARS has previously raised an IT14SD and you had not had the chance to file that IT14SD, then what SARS will do is they will release a specific letter, and that specific letter will request specific reasons based on their search engine or their specific risk parameters that they may have come to think that maybe something is risky in your business. So you can ignore and not focus and pay no attention to any letters that may come through, either maybe by reason of a system problem, where maybe SARS may say on the 27th of this month or later, maybe in the next month, and say, but taxpayer so-and-so, you have an outstanding IT14SD. The note that has come through from SARS is such that you can ignore that letter. The only thing that you have to wait for is the letter from SARS that will say, please submit document this or document that. So this is a very important and a very nice and welcome enhancement from SARS. So it's welcome. It's welcome. Then the other development that has come through from SARS is the move in conjunction with other departments in South Africa. So you have the National Prosecuting Authority, the Hawks, the Department of Justice, and the FIC. And what they're trying to do here is they're going to target all those individuals that have unexplained wealth. And a few politicians come to mind where someone is earning 40,000, yet they stay in a home for 7.8 million, and they can't account for that. So what SARS is going to do is they're going to investigate those using existing legislation, and to the extent that they cannot recover those assets, what they'll do is they'll even consider coming up with new legislation. So this tool that they're going to be working together as all of these departments and for sharing information with one another is the recovery of all of those monies or assets that taxpayers cannot explain. So this is on the punitive side to ensure that taxpayers that engage in dodgy activities are held to account. Then on the positive side, there has been new features on the SARS online query system. Taxpayers, when it was originally introduced, taxpayers could update their public offices and upload supporting documents without the need of going to a SARS branch. So SARS has been continuously improving the technology in this regard, especially since, SARS recently was engaged in a strike, and them continuously improving all of these technologies that they have, these technology offerings. It makes it easier for taxpayers to gain access to information. So in this case, one can now request a statement of account or an assessment. One can do a registration of a trust without physically going through to SARS, and all one has to do is just have specific documentation which SARS lists out in their website and upload those through this online query system. Taxpayers could previously verify a tax compliance status, so that also remains submission of supporting documents, requesting a tax number where you've forgotten it, and also where someone has passed away, a case can be created for a new estate. So that's some enhancement that has been happening. Again, sticking to the positive side of things, SARS has also made some enhancements to the e-booking system, whereby video appointments have been added as a channel, but for specific reasons. So if, for an example, you want to update banking details, you may particularly want to be engaged in a video type of platform where you can see the person on the other end. So SARS has made that improvement. And you as an individual based in Durban or wherever you may be, or in the Western Cape, you can even choose an appointment that like a SARS office that is maybe in the Eastern Cape, for an example. So you're not limited by where you are physically. So that is a very welcome adjustment. And then also a change, but I mean, it's not really a change, but I mean, it's more a clarification that SARS has a 48-hour rule when these appointments are being made. So if you think about it, normally, if you make an appointment on a Monday, it's very hard, if not impossible, to get an appointment booked for the following day. SARS typically allows 2 days in which to obtain an appointment. So where you make an appointment after 4 p.m. on a Thursday, then you typically, SARS would not include or count the following day, which is the Friday, and then the next working day, which is Monday. So you'd typically only be eligible to get an appointment the following Tuesday. Okay. Then my colleagues, I think, already touched on the fact that there's a focus on high wealth individuals. And again, going back to the theme of trying to improve compliance, SARS is going to and has already announced, I think with effect from last year, they announced that they are going to enhance voluntary compliance in relation to wealthy individuals, and they're going to focus on offshore structures that these individuals may be engaged in. Now, the important thing to note here is that based on what has been released in the media, SARS has already 50 permanent individuals focusing specifically on high wealth individuals. And these individuals have already undertaken about 1,500 cases. So, and SARS is also looking to increase the number of people and then to investigate more cases. So, based on what SARS has released and said and indicated in the media, is that they'll focus more on taxpayers with assets greater than 75 million. So my colleagues talked about the fact that it's important to ensure that your tax return is as accurate as possible. So here, as an individual, you are required to list your assets and liabilities. So this is how SARS would typically determine the value of your gross assets, and the emphasis would be on the market value of those assets. And to the extent that maybe you understate, or maybe you have like a funny feeling to understate your assets because you don't want to be part of that threshold, Bruce has already told us that if you answer questions incorrectly in a tax return, then you run the risk of that tax return not prescribing, which I'm sure is something that we all do not want to happen. Okay. Then again, coming to some of the visions that SARS wants to undertake to ensure that it curbs all the non-compliance and malpractices that has been seeing happening. The first very potentially major move or requirement that SARS wants to do in relation to trusts is that it wants to impose an IT3 tax reporting obligation on all resident trusts in South Africa. So essentially what that means is that trusts will be required to disclose all the income that vests to the beneficiaries. And SARS has a proposal at this point of like a 3-month submission timeline after year end, with a goal for like real-time reporting. So if this does come into effect, and it will place a lot more burden, or a lot of checking up on the operations and documents and all of and I suppose also in improvement in technologies as well, because the specific way in which this information would have to be submitted over to SARS. So it could potentially be difficult for your smaller trusts, but this is something that SARS is looking into, purely because some beneficiaries do not necessarily disclose their income that they received or that vests to them in trust. And what SARS is looking at doing is potentially taking that information that comes through from the trusts and then pre-populating that on the ITR 12, so that there is no option but to disclose that income through to SARS for it to be taxed. Something similar again that SARS is trying to change, that they've noticed in relation to Section 18A entities, where I don't want to say, well, there's been a trend of registering as a PBO and then using those PBOs to obtain a donation deduction, and using those PBO numbers as a means of getting that benefit. So here SARS wants to impose an IT3D taxing obligation on the PBOs for them to disclose the identity of the donors and all the donations that they've received. So SARS would then typically know that, okay, I've received 10 million, for an example, from so-and-so. And then you as a taxpayer, you'll know that when you're completing the tax return, you have to put the PBO number of the PBO that you donated to. To the extent that there's a mismatch between the two, then SARS would be able to then maybe flag that for verification. So that is what SARS is looking at doing. The preliminary timeline that SARS is looking at is April 2023, but nothing is confirmed. But these are the things that one just needs to keep at the back of their minds, because SARS is really trying to ensure that they curb any non-compliance or malpractices in this regard. Okay. Then Anushka and Yasmeen spoke about the cessation of residency. If I quickly just highlight what happens when a taxpayer ceases to be a resident, what typically happens is that that taxpayer is deemed to have disposed of all of their assets the day before they become a non-resident, and thereafter they'd only be taxed on their South African sourced income. So how taxpayers could previously disclose to us that they've become non-residents is that they'd either do it via the tax return, the normal tax return process, or they'd do it via the RAV01. So now what SARS has changed is that taxpayers can no longer do it via the tax return. Only the RAV01 option is available. And over and above that, SARS wants a declaration to be signed, to be filled out, to be populated, and then submitted through to SARS with specific supporting documents. And what they're looking here, they're looking at, they want a letter of motivation explaining exactly your facts and circumstances and why you think that you are not ordinarily resident in South Africa. So like you'd have to set out details about your properties, your family, and the fact that you really, really intend to be out of South Africa and not the return. And SARS has already indicated that to the extent that the documents that you submit are invalid, or they do not meet the requirements that SARS sets out, they will reject your declaration, which then means that you'll be taxed on your worldwide income. Okay, then another enhancement that has come through or change is in relation to domestic reverse charge. And here, the main takeaway point to focus on is if you supply or are engaged in the buying or selling of valuable materials. So the takeaway message is, do you buy or sell valuable materials? And the main requirement here, based on the Gazette, which came out on the 8th of June, 2022, and then became effective a little bit later after that, is if you have gold that you're buying, either be it in the form of jewelry or other bars, whatever the case may be, then you are engaged in this supply of valuable materials. And what SARS requires you to do is that if you already registered for VAT and the person that you're buying from is also registered for VAT, then this applies to you. So it's something that is very important to note. And it's just an anti-avoidance type of a measure, because SARS has been noticing a lot of, there's been a lot of media articles again on taxpayers just engaged in very dodgy activities in relation to gold. So what the basic idea is that the obligation to account for VAT moves from the supplier to the recipient. So the recipient must determine the VAT that is applicable on the supply, and then withhold that, and not withhold it, and just pay that over directly to SARS. So there's specific other requirements that SARS places on the supplier and the recipient, that are all those suppliers that meet or fall under this domestic reverse charge regime. Okay, then lastly, and I'm almost done, I'll now take you through the some of the very dodgy type of activities that taxpayers have been engaging, just to make you aware of what has been happening and the fact that SARS is quickly catching up on these. I'll take you through on a very high level. The first matter is in relation to this very poor lady that engaged in 123 cases of fraud. And what she did is she supplied bank accounts, which clients thought were bank accounts relating to SARS, but in effect, it was only her bank accounts. So the monies were paid to herself and not through to SARS. And in total, the tax fraud came to about 2.4 million. And SARS obviously found out about this, and that lady was sentenced to an effective jail time of 15 years. So that's very, very harsh, or that's a very big incentive not to engage in these types of activities. And then we've also seen this case about people trying to submit fraudulent VAT documents. SARS is picking up on that. And touching on what my colleagues talked about recently, where taxpayers just want to quickly submit documents and tax returns just to ensure that they're tax compliant. What these last couple did is they just said, we didn't earn any income, and we have nothing to declare, and we don't have to submit any tax returns. Whereas they had a tender of over $1 billion over a number of years, and SARS has caught up to that, and that case is currently pending. So the last two cases are currently pending. And I think the most famous that we've seen recently that has been reported on a lot in the Daily Maverick is the case of Gold Leaf, which Yasmeen talked about earlier on. And SARS, the important thing to note here is that SARS actually applied for a preservation order because Gold Leaf was found to have not declared over 2.5 billion of income from these illegal or illicit cigarettes that they had, and also not declaring VAT. So what happened there is that the court saw that, you know what, in fact, there's a real risk of these taxpayer or this taxpayer dissipating their assets, and SARS won that. And very sad to hear that Sasfin Bank was also implicated in this, because one of their, which boggles the mind, but one of their employee was able to delete records where essentially the scheme that they're engaging in allowed them to siphon money out of the country and then transfer it to Switzerland, I think Dubai. I think Dubai is one of their favorite places to do these types of dodgy activities. So money has been moved outside of the country. There's also potentially change control implications. So no doubt the South African Reserve Bank will also be onto this. So in essence, I think the theme has been that SARS is trying to ensure that they do as much as they can to ensure that all of us are as compliant as we can, and to the extent that we engaged in or engage in activities that they deem to be not right, then they want that to be punished. To that end, that brings me to the end of my presentation. I would like to thank you very much for sticking with us and remaining until the end of the presentation. We look forward to seeing you again during the next session, which will most probably be the budget event in 2023. Thank you very much.